Welcome to the Income Protection Podcast. If your income is high, specialized, or tied to performance, whether you're an athlete, an actor, founder of a company, a C-suite top-level executive, or another ultra high earning professional, you may not even think income protection applies to you. And if you do, you probably assume what you have will always be enough. But as income grows, careers evolve, and lives become more complex, coverage often breaks down long before the financial obligations do. Today, we are talking about where those gaps really are, why so many high earners never see them coming, and what it actually takes to protect income at the highest levels. My guest today is Tom Petersen from Petersen International Underwriters. Tom is a senior partner at Petersen's, one of the nation's largest underwriting firms for specialty disability insurance coverage through Lloyd's of London, where he leads special projects and industry relations. He brings a rare combination of financial, medical, and forensic expertise to the disability insurance world, with an MBA from Pepperdine and advanced medical training through UCLA's Center for Pre-Hospital Care. Tom is also a founding board member of the International Disability Insurance Society, a recipient of its Lifetime Achievement Award, and holds numerous advanced professional designations across underwriting, claims, fraud investigation, and forensic examination. Beyond insurance, he's an entrepreneur, licensed investigator, EMT, master scuba instructor, and U.S. Coast Guard licensed ocean captain, experience that gives him a unique, real-world perspective on risk. Tom's firm specializes in coverage for situations where traditional insurance falls short, including supplemental disability, professional athletes, entertainment professionals, artists, pilots, ultra high income earners, founders of companies, international medical coverage, and even kidnap and ransom insurance for clients whose careers, income, or lives cross borders. Today, we're going to talk about what's happening in the specialty insurance market and what it means for anyone who simply can't afford a gap in coverage. Welcome, Tom.
Hey, good morning.
So let's start out with your history. So give us a little bit of background. How did you get started in this business and what sort of attracted you to income protection?
Hmm. Well, Jamie, what I have found is I, like most people growing up, never ever thought the insurance world was of interest or somewhere that I would ultimately end up. Even though I had family who was heavily involved in specifically the disability insurance world, namely my father, and later on my oldest brother was in the industry with my dad as well. But growing up, I was actually a marine biology major, and my whole life was in, on, or under the water. I was heavily involved in the scuba industry for many years, and not just at a level of teaching diving, but setting. I actually worked with PADI, PADI,
Mhm.
a certifying agency to help develop a lot of the modular training programs that we see today and setting new standards. See, in the late 70s and the early 80s, scuba was still a very, very new sport out there. So, we ultimately had to get fine-tuned to make it something that was safe and practical and consistent, available for a recreational diver. So I was involved at the industry level, not just at the teaching level. I had fully expected that to be my life career until one night a drunk driver decided to completely alter my life career, my life choices. A lot of people don't know this story because I don't share it very often, but
Wow.
um, uh, guy came running through a red light with a big heavy duty car, T-boned me, pushed my car across three lanes up over a curb and into a wall, which is what finally stopped me.
Oh
Uh,
my God.
so while I was trying to figure out what to do for the rest of my life, because it took over 6 months to learn to walk again,
Wow.
um, the my dad, who again up to that point in time when insurance was discussed, it was like, oh no, look, I can't hear you. That's that terrible thing that I just don't want to talk about. And so my dad approached me while I was, like I said, just kind of feeling sorry for myself, thinking, now what? Um, and he said, would you like to help me with some marketing things? And marketing, oh, fun, interesting, creative. Yes, I like those kind of things. So he said, oh, great. Well, first you have to learn a little bit about the insurance world. It was a trick. It was a trick, but you know what? I learned an awful lot in that first day. Um, First, before I tell you what I learned that day, what I learned, which I didn't know at the time, but looking back on it, that accident, within 3 months, my business was gone. That's how
Wow.
fast it shrivels up when you don't have an income that you had from that business, gone. Because you see, especially in the scuba industry, people don't wait and say, well, I'll talk to you next year. I'll wait till you recover. They'll say, I'll go
Wow.
down the street and take lessons from someone else, or I'll go on this trip with this other person, or do whatever we need. In other words, life moves on and you're not part of it anymore. So that was an eye-opening experience. But again, at the time, didn't realize the impact of what not having disability insurance or business overhead expense. Because to this day, I swear if I had it, I probably could have survived the business
Wow.
for any period of time. But good news, I think in the long run, I didn't. And so my dad said, okay, you need to learn a little bit about the insurance world. And here's the interesting thing, because insurance gets a bad rap, within any industry really. And what I found listening to him and listening to stories and thinking back on it is that we have always believed in insurance. We, everyone, the society, the world. It's just we never formally called it insurance until more recent times. And so, and here's the examples that really hit home. If you think of going back to a time that we were a hunting and gathering society, well, a hunter whose arm was broken and couldn't go out and hunt, they weren't kicked out because they couldn't go hunting this week. Someone took care of that arm. And I put to you, that's our first medical insurance policy in place. Someone who took care
Yeah.
of them. That same person also was still kept with shelter and provided food. And that's our first disability insurance that was taken care of. It was the community taking care of each other.
Hmm.
And even the most elder, senior chieftain of the tribe couldn't hunt, couldn't gather, but was still kept within the society. Why? Because he had experience and wisdom that he could share, but nothing else. Well, that's our first long-term care policy in action. We took care of these people. Now, when you go forward into an agricultural society, you have a situation where we're farmers. And if Bessie the cow knocked over the lantern in my barn and my barn burnt down, I guarantee you all my neighbors would come together some Saturday and each contributing a little bit of nails and a little bit of wood and help me rebuild the barn. Why? They know that if their barn burnt down, I would be part of the community that do the same thing. Well, here's the trick in all this. I don't know how to build a barn, but I still contribute to that same neighborhood, that same community. But now we call it an insurance pool. I contribute money into this pool. And if the barn burns today, we reach into that pool to hire someone who knows how to rebuild that barn. That's all insurance is a way for the community to be together to provide the services that we need. And we've always believed in it.
Yeah,
So,
I really like that analogy. And I think something that's sort of telling, like you were talking about sort of primitive times or way back
mhm.
when the community would all help each other. Do you think that today, in today's world, people don't really have those types of situations in communities and support systems in place? And that's why it's even more important to have an insurance company or backing to replace those needs if something happens.
That's a good point. I hadn't really thought about that, but there's some definite merit in that thinking as
I
well.
mean, I think about it like in my neighborhood, people have moved in. I don't even know all my neighbors that well. Something
Right.
happened, like I know, I wave to them, I know who they are. I don't even know their last name, some of
Uh-huh.
them.
Right. Right. Right.
So,
But we're
you
still part of the
can't
community.
rely on the neighborhood anymore.
Right. 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 But
So,
that's what got me into the disability insurance world, and just from that point on, I never looked back, and I've enjoyed being a part of this industry ever since. I'm coming up to, well, it'll be 40 years in well, I think next year I hit 40 years.
wow.
So.
Now, your firm is unique where you really specialize in what's called specialty disability insurance
Mhm.
as opposed to the traditional companies. Can you kind of explain the difference between what a specialty insurance company does versus just a traditional company
Be
does?
be happy to. So within the insurance world, we have the standard traditional carriers, and if we're talking about disability insurance specifically,
Mhm.
so you have Guardians and Principals and Standards and Mass Mutuals and so on. And if I miss any of them, I apologize. But my experience, whether it's group disability or individual disability, they all do a fantastic job with the vast majority of situations that they encounter. And I will always go forthright with saying that they do. But they do each and every one of them have limits of certain sorts. Now, in some cases, those limits are the maximum benefit that they can provide. In other cases, it's the type of occupations. If you thumb through an underwriting guide through any one of those carriers, you will find lots of places that say no, 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 no in there. And that's because in the traditional disability insurance world, they are writing policies where they're looking for persistency, uh, consistency, a decent income and or an income that again that's going to stay level or at least be um, calculable for a fixed period of time, and as well as your health. And then that those are all situations that they have to look at. And being that their policies are written on a non-cancelable to age 65 or longer basis, you're 30 years of age, they have to really think about what they're going to be offering. So they typically limit the types of benefits, the maximum benefits that they can offer. Now, in most cases, they will say to you, we write two-thirds of a person's income. Statistically, that is the magic number that we look for. And that's not just the insurance industry that says two-thirds. Um, if you go back in, over the years, there's been different studies. One of them is the U.S. News and World Report, as an example. U.S. News and World Report did a sampling of their readers many years ago, and most magazines want to know the demographics of who's reading their magazine. But what they found is that regardless of income level, a person dedicates about 40% of their income to the mortgage of the house.
Hmm.
Now, you notice in there I said 40%. I didn't say a dollar amount. So if you think about it, a person who makes $100,000 a year, yeah, they have a certain size house. It's like so. Person who makes $10 million a year, do you think their house looks like this, or do you think the house gets a little bigger?
Much bigger. Yeah.
So dollars get bigger, but the percentage stays the same, 40%. They want a bigger home, a nicer neighborhood, whatever the case may be. And that is not something that's frequently taken into consideration by the traditional disability markets. Um, they will go up to a point, but interestingly, as a person's income goes up, the percentage that they're able to offer a person goes down.
Hmm.
And in many cases, a person who makes $500,000 a year, which is not an incredibly high income, it's definitely a large income, but it's not a high income. If you look at the issue and participation limits of the traditional disability carriers, you'll find that's probably about 40% of their income. Now
Hmm.
that, going back to my numbers with U.S. News and World Report, 40% was just the mortgage of the house. They then went on to find out that about 25% of a person's income was needed for utilities, food, basically living expenses. So 65% needed just to stay alive. That's to survive, not to thrive. So that being the number, there's our two-thirds. And that
Hmm.
was a demographics of a magazine, had nothing to do with the insurance industry.
So
The
what's sort of the threshold? Like at what point, because you mentioned 500,000, yeah,
yeah,
we have a lot of clients in that range. And for most of them, the traditional companies are enough. What is sort of the threshold of income where you consider that's a high income? They really
well,
need to.
here's what you'll find is a person whose income starts at about 150,000, you'll start seeing that gap starting to expand in there. Now at 100,000, 150,000 or lower, that gap might be small enough that it's not going to, mentally it won't impact a person. They'll say, well, it's a $500, $1,000 a month difference, not a big deal. but it starts going up right at that point in time. So, we have always told insurance professionals that the $150,000 should be a trigger point in your conversation. That if a person says my income is and it's above that number, that's a good time to start talking to them about saying, well, we can get you additional coverage beyond what you're getting from, again, the standard markets.
Yeah.
Again, no complaints with the traditional markets. They do a fantastic job with the vast majority of situations. But again, as that income goes up, the percentage that they offer goes down. Group
So a lot
disability.
of times, so like right now, we can get, if somebody's making, say, 1 million a year, between two companies, we can get them up to 30,000 of
Mhm.
tax-free coverage. Is that sort of the threshold? If somebody's making 2 million, 3 million, 5 million,
Oh, yeah,
then they
you
need
went
to
past
really
the
bridge
threshold
that gap.
long. Yeah, you went past that threshold long before that number.
Yeah.
30,000 a month is what, 20% of their income.
So if somebody does make, let's say they make $10 million a year, how much can they insure?
Well, in a perfect world, we can go up to 65% of their income, regardless of their income. Where we come in is what we typically refer to as excess coverage. And much like an excess liability policy, it layers on top of whatever their existing coverage is. We're not there to replace that base coverage. We're there to add on to it. So if you have the 30,000 as an example, or whatever the maximum is that they could get based on that income, we can come back in and layer an additional amount of disability protection on top of that up to the 65%, regardless of the income level. So in a perfect world, that means, we can, there is no really upper cap number that we work with. Um, Now there may be some variables in there that we have to deal with that may change that a little bit. But again, in a classic perfect setting, there's no reason why if someone needs 200,000 a month in benefits, we can get them 200,000 a month in benefits.
Mhm. Is there ever a time where you say they don't really need it anymore? They've got so many assets, they're making 10 million a year, they've got this huge portfolio. Do you ever advise, you know what, you probably are beyond needing this?
Yeah, well, again, every case is going to be a little different, and sometimes what you find is that type of a scenario is a lot of those assets might be tied up in something other than their personal situation. It might be a foundation that really owns it, and they don't. In which case, we can look at giving them the additional coverage. Um, I can't think of any time that we've ever said, oh no, you have too much already. I'm sure it's happened, but it's not necessarily because of all the assets. Again, one of the important things with insurance is not just to replace the income, but it's also protect the assets. You buy life insurance for that reason. It's, let me share a little story with you from a number of years ago. Um, this is going back maybe 30 years ago. I was at a conference, and so I had a conversation with one of the reinsurers. In the traditional disability markets, there's only a couple of reinsurance markets that they go to historically. And here were two people, high up executives from that company, who will remain nameless, but it was, again, a very well-known, strong reinsurance company. Typical, they are East Coast, Yankee-based, New England kind of folks who think that the rest of the world just doesn't quite understand how the world works, especially in California where you live, where I live, right? Um, and so I said to them, what's the proper percentage of income a person should have? And they said, oh, about two-thirds of their income. That was right out of their mouth. I said, wonderful. So why is it that when a person makes $500,000 a year, and that was the exact example I used, that they can only get 35 or 40% of their income? Without blinking of an eye, that both of them looked at me and they said, a person whose income is that high could sell one of their homes in order to take care of those expenses. Now,
Wow.
I had two problems with that statement. Number one, that's not what insurance is designed for. And number two, isn't part of what you're buying insurance is to protect your assets, not, oh, here, I have enough that I can liquidate this. And
Who are they to judge
exactly.
how
And
much they can or what they need
well,
to live on? It's all
well,
relative.
and the other irony that I got out of that was their assumption that at 500,000 a person had multiple homes. No, they have a
Exactly.
bigger home.
Yeah.
You
I
know.
actually had a case that we did with you years ago. It was on a football coach, and he needed $200,000 a month to live.
Mhm. Yeah, right.
And I mean, I'm looking at that going, wow, I don't know where I would do that, but you know what? For that
Yeah,
person, that's what they needed to live. Maybe they had security in multiple homes, and
exactly.
who knows what they were spending. It's not my business. They wanted to insure it. They were
Right,
saying if something happens, that's what they need. That's what
right,
they need to live on.
right.
It's all relative.
It is, and it's always interesting how this is one of the reasons a lot of the disability producers stop or don't sell disability insurance because they put that fear of what is in their mind in that situation. They sit there and say, well, I don't think they would need that. Well, you don't know that. You need to
Exactly.
you need to ask them, that
Exactly.
and again, to me, disability insurance is twofold. We always think of historically as just income replacement, but it's asset protection as well. It's I want to keep what I have, and that takes money.
Yeah. Well,
Now the
it's
question I
also
have
in
is,
those really ultra high income types of scenarios, they're also wanting to save more and and have that compound. So if
mhm,
they're not able to work and the income's not coming in, not only do they not have the income, they also they're not adding to their portfolio and saving
correct.
more and putting it away.
Right. If your house is completely paid for, guess what? You still have living expenses that have to run it.
And
Yeah,
taxes
yeah,
and
property taxes have to get
exactly.
paid, and utilities have to get paid. And if you have staff that work with you, they got to get paid. So, all those things still take, I would always, growing up, my son would always come up with things like, he was 14 one time and he said, hey, Dad, can I buy a motorcycle so I can go off-road? And I go, well, we don't live near the off-road. So how would we, and I would explain to him, it's not the cost of the toy. It's the cost of keeping the toy. And that is the hardest. And he like, what do you mean? I said, well, okay, let's get a motorcycle. How am I going to get it out to the desert for you? Well, we have to get a trailer. Ah, we have to get a trailer. Guess what else we have to then do? Store it somewhere. And you have to maintain it. Oh, and you have to
And what
pay.
does it cost to get insurance on a 14-year-old
You're right.
riding a motorcycle?
Yeah, and then a trailer, and then I'd say, but you don't drive, so he's, well, you could drive it out there for me. Well, what would I do while you're motorcycle riding? Well, you need to get one too. Oh, so now we need two bikes, a trailer, a storage, registration. I said, you see, it's not the cost. When you start out saying it's only $2,000 for the motorcycle, we're up to about $10,000 just to get it out there. So it goes back to that same scenario. It's not
Yeah.
just because you have a house doesn't mean it's paid for. I mean, that it's free and clear with all expenses. You still have to pay to maintain it.
Absolutely. So you talked a lot about sort of the types of people that need specialty insurance because their incomes are really high and there's
Mhm.
gaps in the coverage that they already have. You also mentioned that when you look through the book and you see all the different occupations, there's a
Occupation.
lot of different occupations that are not covered in the traditional carriers. And
Right.
the ones that come to my mind are the athletes, the entertainers,
Mhm.
some of those who make very large incomes. And I know you do a lot of work in that area. So maybe tell us a little bit more about, let's start with the athletes. What does it
Occupation.
look like for an athlete? What kinds of athletes can get insurance? When can they or can't they? And how does that work?
Well, yeah, once you get into the athlete world, it's a very different world because and the rules change at the younger ages, namely college. The
Yes.
last couple of years, colleges have now started allowing for what um, that they can actually pay college students to be playing now and pay for expenses and pay, whereas years past they couldn't do that. So now you have not just what a college senior might be valued at to turn professional, but what they're getting paid now is something that is insurable. And their situation might be that they're paying back a contract. It might be the school that needs the protection. The school says, we're paying this person $1 million. We want to make sure we get $1 million value out of them because they become, they're in a bad car accident and they can't play. we're out the million, and the school doesn't get the benefit of the player. So that world constantly changes all the time. In the professional side of it, again, same thing. What we have to look at from our standpoint is we look at what the contracts that they have, and as far as what the insurability is. And where we come in is where we would be able to insure the non-guaranteed portion of any contract. What do I mean by that? Well, we frequently will hear on the news, such and such got a $3 million 3-year contract. And you go, oh, that guy's get $3 million. Well, you got to look at the contract. Contract might say, we're going to give you $1 million each year, but if you're disabled today, you're still disabled in year 2 and 3. We're not paying you years 2 and 3, but it's still a 3-year contract, and it's still
So you're still on the roster, but if they're on the bench because they can't play,
right
they're
there.
not going to get paid.
Right, right, and that happens fairly frequently in those types of contracts. So they always sound fantastic, but you have to dissect them and look at well, what would they not get? That not that they're
And can they
guaranteed.
insure the full amount? So let's take the 3-year, $3
Yeah,
million player. They
right,
come to you.
right.
How much can you insure and what does that look like?
Well, with that scenario I just gave you, we would insure 2 million because 1 million was guaranteed to them
Okay.
of the three, but it's 100% of the contract is what we're insuring, not just
And is it totally disabled or what if they're playing
typically.
less?
Typically in the athlete world, it's going to be a career-ending type of disability. So it's not
Oh, it
one.
has to be career ending. It can't just be they suffered an ACL tear and got
Right,
surgery.
because statistically they'll be back on the field pretty darn quick, or within
Okay.
a few weeks, if not a couple months, without
Okay.
a problem.
But they break their neck, they're out.
But
And
there
yeah.
could be others, like professional golfers, for example. We can insure them for the what we call the temporary disabilities, like what we just
Okay.
described. Their
And
road.
how do those work, just for the people that are listening that have no idea? Are they just paid? Is there a waiting period? Is it a lump sum? How does that work?
Now, in the career ending situation, it's typically a lump sum. There's typically about a 1 year waiting period. Typically, again, every case we can kind of look at and kind of customize a little bit, but generally there's about a 1 year waiting period. And then again, statistically, if you're not recovering in 1 year, you're probably completely disabled at that point, at least from coming back to play
And
professionally.
then do they have to renew the contract? Like every 2, 3 years, they go back and they say when they re-sign a new contract, they redo their insurance?
Yeah, the first scenario is they would be on claim. So if they're on claim,
Yeah.
then this doesn't take place.
Then it's
But
just
yeah,
paid off. Yeah.
that's correct. I mean, it's um, once the contract's over, we then look at what are they doing now and re-underwrite it based upon what their current situation is.
Yeah. Okay. That
So,
makes sense. Now,
yeah.
how does NIL come into play? So I
And
know there's a lot of, especially even the college athletes, they come in and they maybe they're not actually being paid, but they're getting NIL, the name and likeness, and
yeah,
also the professional athletes. So a lot of their income is derived from endorsements,
right.
advertisements, promotional things. How is that taken into consideration?
Well, there first, my experience has been there's no such thing as a bad risk, only a bad premium. So we look at every case differently. Over the years, we've included things like death and disgrace. A player who that might be still a top athlete, but because of some scandal, they're now kryptonite. No one wants to touch them. That could be an
So
insurance.
that could be a covered claim.
They could be, right?
Wow. Or they go to
Um,
jail or something and
yeah, yeah, exactly. So there's different cases, different situations that we
But what about the one that, like I follow gymnastics. That's my favorite. So I'm
uh,
thinking Livy Dunn. So she's a gymnast, she's with LSU, and she makes, I think, 5 million a year in her NIL.
right.
Is that something that can be
There
protected?
is.
And how does that work?
Yeah. Well, again, just like any other insurance policy, we look at what what is the term of that contract really saying, and then also say sometimes the schools will buy the coverage instead of they say we're giving this person 5 million, so they might not need it, but the coverage. But we as a school, if if she goes down,
But
we're
would it have
outside.
to be an injury? Because I'm just thinking to myself in that scenario, if let's say she has a career-ending injury, but she's still, doing her ads and she's got all these followers and she's still making money from the endorsements,
Right? Yeah.
where there's
Well,
really no loss of income, right?
okay, but it goes back to unable to perform her duties. So
Okay.
if we were insuring her as an athlete, we were insuring her as an athlete. If she's able to do something else, that's
Okay.
a completely different discussion. Now,
So to so maybe just shifting it, are
yeah,
influencers able to get policies
they
then?
are. I
Okay,
mean,
so maybe tell me a little bit because that's sort of a whole new.
it is. And actually some of our standard markets are starting to write some influencers as well. So
Okay.
it's kind of
Because how do
creeping
you
in.
calculate the income? Maybe this year they're making, 200,000,
Yeah.
next year they're making 2 million, but maybe they don't
The
stay
next
as
year's
popular.
zero.
Like how
Yeah.
does that happen?
Yeah.
How do you look at the risk?
Well, that comes back to more our expertise than the standard markets, because the standard markets try to look at the long, like the next 10 years, what's going to happen. And for us, we typically look at what's happening in the next 12 months or next 24 months.
Okay.
So a lot of in the markets like that, we oftentimes our policies will only be 1 or 2 years long, and then we reevaluate it at that time. Are they still high up with their followers? Are they still producing what they're supposed to be to produce? Have they increased or decreased? And then we can
And then for
reevaluate.
income verification, do they show, well, here's what I earned the last 2 years just to show an income pattern?
Uh, typically,
Probably.
typically,
Yeah.
yeah.
Okay. And then what about like in the entertainment industry? I assume it's kind of the same thing. What about people that maybe do you do it on a contract basis? They get somebody for a film and they get them a big contract. You just do it for the film? Is it
We
for like how
both
does that
ways.
work?
Both ways.
Okay.
It can be by a contract itself, or it could be, for example, sometimes we do entertainers who do tours, and so they said, I'm getting X amount for every city we go to and each venue we go to, and so I only need for the next 6 months to do 15 venues. Okay, we can work with that. But if it's someone on a more personal disability income basis, we gotta look at who are they, what's their background, what's their experience. You have someone like a Tom Cruise who he might go 2 or 3 years in between doing films. So, you showing zero income for those 3 years. However, it's Tom Cruise. If he says, I want to make a movie, he can make a movie. And
Yeah.
we know he's going to be hired. So,
Or
uh,
I'm just thinking, so, last summer I saw Billy Joel and he was, on the scene and doing these, and then he canceled his tour this year
right.
for some kind of medical, I think he had some kind of either cognitive or some kind of
Yeah.
brain something.
Yeah.
And I was thinking to myself, I wonder if that was insured. Is that the kind of thing
Yeah.
that
That
you
could,
just insure for that year? And so since he canceled 6 shows that were worth, X
right.
amount, that amount is
Yeah. And,
replaced?
and, and frequently then it's just a benefit that's paid based upon the per show basis, what they
Okay.
would have been typically. Again, we look at contracts and what the situation is. But yeah, that would not be an uncommon situation.
Are there any kind of professions that you guys just say, absolutely not, we will not even touch that. That's just, we deem that way too high risk?
It's not so much because of too risky. It's just more of situations or markets, and it's not necessarily a permanent situation. Sometimes it's just no, we're not interested right now. And in our world of Lloyd's, I always tell people if you get a no today, ask tomorrow. Literally, I mean it could change. Lloyd's is a marketplace, so we're not limited necessarily to just one person or one source of our binding protection there. But as a market, they might not have an appetite for something today, but they might tomorrow, or vice versa. Let me give
Hmm.
you an example that really illustrates this. So go back a number of years ago when beach volleyball first became professional.
Hmm.
That first year, we insured 19 of the 20 top pro beach volleyball players. You might remember names like St. John Smith and some
Oh
of.
yeah, yeah, yeah.
Okay, so this at that time, pro beach volleyball was very new. The season was 6 months long, whereas today it's now greatly expanded. Um, And so these players played for 6 months. Isn't it interesting that right about the 6 month mark, almost all of them became disabled? So fool me once, shame on you. Fool me twice, shame on me. Yeah. And then when the season began again, miraculous recovery from almost all of them. Back to go playing again. So the next year, when they said, "Can we get disability insurance?" Guess what they were told? Absolutely not. We're not insuring pro beach volleyball players. We'll insure boxers, won't insure pro beach volleyball players. Now, see, at the time,
Wow.
that sounded really funny, didn't it? Why would you take the boxers and not the pro beach volleyball player? Because the industry got burnt by them. And that had nothing to do with
It wasn't really the risk, it was
right.
they sort of ruined it
It
for the
was a little
others.
right. Now, time rolls by a little bit more. We love pro beach volleyball players and we write them frequently now. So the sports become more standardized, more consistent for the players and stuff. So all year long. So
Yeah.
there's things like that that can move the market. But again, I go back to there's no such thing as a bad risk, just a bad premium in most cases. So,
What about for life insurance? You guys do life insurance as well.
oh,
I know life
yeah.
insurance risk is looked at differently. Are there certain risks or certain
Well, we
profiles that you just say that's
now
just too?
we generally, in the purest of sense of life insurance, as you're thinking of it, we are not able to write life insurance. Um, we're what we have two avenues that kind of become life oriented, but they are different from traditional life insurance. First one is accidental death. That we can write any amounts on anybody for almost anything, but it's limited
And
to
you're able to do that regardless of health, correct? Some
generally.
of
Yeah,
those.
yeah.
Yeah.
Now
So if
there's some
somebody can't get life insurance, maybe they got turned down somewhere else because they had cancer 2 years ago.
right.
They might be able to get
It,
an accidental death policy.
right, right. And sometimes people will use it for a temporary gap. They say,
Yeah.
they told me they can review me in 6 months, so I can
Yeah.
take coverage for 6 months.
And
So
for people listening, an accidental death policy means a death not caused by natural causes. So
correct.
car accident or plane
Right.
crash or something like that.
Now we have one other avenue that comes off there that's in the life market, but it's not, again, the traditional life insurance, and it's referred to as failure to survive. So it kind of sounds funny, but say in that life insurance, no, it's actually failure to survive. It has to be tied to a contract, a work contract of some sort. So it might be a business partnership. It might be I'm hiring this guy as a key person to do something, and so we're paying them, and here's the contract that we're doing to hire them. We will insure the contract, not the individual. So it's subtle,
Okay.
but
Yeah.
it's an important distinction that there just needs to be some business contract relationship in there.
Okay.
So,
Okay. We're going to take a little bit of a
but that's the same thing. It's for some of those unique situations that you just can't get traditional life insurance for.
perfect. Okay, we're going to take a break. We're talking with Tom Petersen of Petersen International Brokers, and when we come back, we're going to talk more about different kinds of risks when it comes to income protection in the specialty insurance marketplace. Stay with us.
Okay.
All right, we're back. So, Tom, another area I wanted to discuss with you, another area where we've used Lloyd's in the past is people who might not be able to get insurance elsewhere because of health issues.
Yeah.
So, I know a lot of times people say, "Oh my gosh, I've been turned down. I'm never going to be able to get insurance again." Maybe if you can speak to that, is that true? Meaning you get turned down by one of the traditional companies for disability insurance. Are they able to come to a company like a Lloyd's and be able to get a policy?
Yes, that's very true. And they have a high probability of being able to get coverage. In some cases, they might be turned down again, kind of like on a temporary basis. The eye carrier says we can relook at this next year, but right now we don't want you for whatever reason.
Mhm.
Uh, you might be recovering from something. You might have had alcohol or a drug hit on something where just at the moment the company just doesn't want to take a chance on you. Um, many times will write those types of coverages where we can then give them some sort of protection for the next 1, 2, 3 years, and then by that time they can maybe go back to again standard principles, the standard
So
markets.
how are you able to insure them when the other ones can't? So I'm
And
thinking of situations like maybe somebody had cancer 3 or 4 years ago,
right.
or maybe they have Crohn's disease, or they have, type 1 diabetes. How is it that you're able
We
to do it where the other ones are not able to?
Well, it has to do with flexibility on our end. Number one, our contracts are typically 1 to 5 year maximum benefit periods. I'm sorry, maximum policy periods. So
Mhm.
versus the traditional markets again, they're going to write a policy that's going to be non-cancelable, typically to age 65. So when they accept someone in their 30s or 40s, they're locked in once they say yes. So they're more conservative with how they look at health issues compared to what we can do because we can say, well, based on that health situation, we suspect you're going to be okay for at least the next 5 years, the next 3 years, or 2 years, or whatever. So we can work with that to some extent. Also, we have the ability to put more exclusions onto policies, whereas a lot of the traditional disability markets are not big fans of multiple exclusion riders on there. So we might again, you might have a significant number of health issues. We can probably exclude most of them. And then I know some people say, well, then why should I get the coverage? Well, 5,000 known diseases, and we're telling you we can't handle a couple of them, but we'll cover you for everything else and the car accident and anything else that can happen along the way. So we can still typically get something for somebody, for
And is there sort of a threshold? Because I know in the traditional carriers, people that have had cancer, usually 5 years, 7 years is sort of the mark. Is
Mhm.
there a threshold with your policies if somebody's had those types of pre-existing?
Generally not. It depends on, again, our world is all custom created. So we look at each case separately, not, traditional disability markets from an underwriting perspective. You have a square peg in a round hole, doesn't fit, we're done. End of discussion. We sit there and look at it and say, well, do we make the peg square or this round, or make this bigger or this smaller, or
So it's
how?
really bespoke. It's
So
really much
it
more.
is, yeah.
Yeah.
Every case is very very customized to that particular situation.
And you mentioned the drug hit. So we're seeing more people who use marijuana or use drugs.
Mhm.
And sometimes, again, the traditional carriers are say, no, we don't want this. How does your company, how do they look at people who use drugs, even whether it's recreationally or regularly?
Yeah. Well, it's only partly a question of how do we look at it. It's more of in its totality of who they are, the age, their health issues, it's a whole combination of things. Um, Person who habitually uses narcotic type drugs, been in and out of jail, there's probably a chance we
Yeah,
won't write that.
not a
Um,
great risk.
but
Yeah.
uh, marijuana in most states is recreational, like tobacco anymore. So, that's something we can deal with, but there's
So they might get smoker rates, but it won't keep them from getting a
that,
policy.
right.
Yeah. Yeah.
Exactly. So
Okay.
again, every case we look at is unique to itself.
Great. Now, you also mentioned that you do a lot of work, like in Washington and advocating and doing stuff more broadly with the industry. Can you tell me a little bit more about kind of what's going on in the industry, trends that you're seeing, um, obstacles or challenges that are going to be happening in the industry going forward?
Well, when we get together with different industry association and organization meetings, it's always nice to hear what the regular markets are doing. Um, the general rule in our world, because our insurance is written on a what's called a surplus lines basis, that I don't need to get down to the weeds on all that, but it basically you come to us as Lloyd's when the standard markets can't or won't do something for you. So we're not the first markets you go to, we're the last markets you come to. And so again, we exist to fill the holes. We don't exist to start you out and get you everything you need going there. So so that being the case, it's always good to know what the industry in its totality is doing because our marching orders are based upon that. As an example, some of the in the admitted markets, they are starting to raise their issue and participation limits. So they are issuing higher benefits than they have in the past. That means our threshold for starting starts higher up for on the excess disability markets. Um, they are looking at occupations like gig businesses, Uber drivers, and they're also looking at influencers more and more. So as that market develops and increases, access or the need for us to provide those coverages starts going down more and more. So, those are just general industry trends that are going on. From a political standpoint, there's not a lot really that hits the disability insurance market. It's one of the few that everyone kind of stays away from or just doesn't. I think it's small enough that people just don't
Yeah, it's pretty
typically
stable. Yeah,
look
not a
at it.
lot of
Yeah, it is.
changes.
It is,
Yeah.
right.
Yeah.
Um,
So what is the most unusual policy that you've ever done in the income protection space?
oh my gosh.
I mean, you must have some wild stories of ones that you've had or
Yeah. Uh, let's see. Yeah, I gotta think about that one because um, the one that that I think is one of the funniest, but is not necessarily the one that's best to share. But I'll share it, and you decide.
as long as it's anonymous, it's good. Yeah.
So this goes back about 20 years ago. I got a call, and what made this one very funny was the producer. I happen to know the producer, and she used to be a Miss Nevada, and she bright, sharp lady. I really had a still do have a great deal of respect for her. And at the time, she was in her early 20s, and she called me up and said. Um, would you insure a prostitute? And my just kind of the standard pitch is no, we don't do prostitutes or exotic dancers. Now, historically, the main reason is because it's a cash business. So
Hmm.
there's no way of really knowing what their
It's not a
income.
moral thing, it's a cash. Yeah, yeah.
Yeah. And so I started explaining that. And as I'm going down this rabbit hole with my discussion, I'm going, wait, time out. You're in Las Vegas. Yeah.
Yeah.
Does she work at the legal brothel? Yes. Oh, so we have a legitimate business,
Yeah.
at least in Nevada. What's her annual income that she reports to the IRS? $150,000 a
Then
year.
yeah.
Got a good income. How long has she been doing that? 10 years. Persistency. She hit all the right parameters. So
Yeah.
I'm sitting there going, I don't see any reason why we can't. And now it's just, you have to take away your,
There's got to be something about the career-ending injuries in there, but
yeah.
yeah.
Well, so we were able to provide the coverage for her with this particular lady who made a fairly decent income. Um, so anyhow, but of course, as I get this information and I'm trying to convey it to our guys in London, I have to go through all the jokes, all the
I'm
discussions. But
sure.
the real point of the story is not so much the occupation situation, but it's you see, we listen to what the situation is, and every case is different, and it fit all the boxes we needed to make it work, and we developed something that made it work.
Yeah.
So,
I think that's a great story. I think
so
it really is because you looked at it specifically with as long as she was able to, like you said, check all those boxes.
the
It's really
persistency,
she's a professional, she's doing her work,
yeah,
you know.
yeah. I mean, you got, morals have to come out of it. It has nothing to do with that. It has to do with it's a legitimate
But
business.
there it's actually legal,
So,
so
right. Yeah,
yeah,
exactly.
yeah.
Exactly.
So,
But and we've done things like on the accidental death side, we this goes back a number of years ago, but let's see, what was it? Four executives were going to do. Let's see what I can't remember the oh, they were going to do a promotional stunt of jumping out of an airplane in parachutes, obviously. Um, and they were getting ready to do this, and it was going to be promoted on a radio show or whatever. And all of a sudden, it dawned on the company as the four top executives got on this plane. Oh my, what if
What
hap
if it, what if,
yeah, yeah, what if the plane crashes? What if
risk?
chutes
Yes.
don't open? We just wiped out the whole C-suite.
Yes.
And so we got the call, and they said, we need $10 million on each person. And here's the problem. They're getting on the plane right now. Okay, we can do that. And we did.
For
And
the right price. Yeah.
so, yeah, that's right. No such thing as a bad risk.
So was
Okay.
that almost like no medical questions asked?
Right, right.
So you
Because
must have
it didn't
charged a good
matter.
sized premium
They
because
they just
weren't
need
able.
they just needed it for that one event, and that was
Yeah.
it. So
Wow.
so things in the world of Lloyd's, it's all very unique. It's all bespoke, as you said. It
Hmm.
truly is. We look at the situation and we can we do this? Can we provide something here? And,
Yeah.
and it works.
That's great. Well, thank you for coming on. I really enjoyed our conversation, learning more about specialty insurance, specialty disability insurance, I should say, because it really is truly unique and different than the traditional markets. But there are people even that are looking for traditional markets that might also need to fill in those gaps
They
that,
definitely do.
like you said, over 150,000 and up, they might need to still plug those holes and fill in those gaps.
Absolutely.
So thank you for coming on the show today, Tom. I really enjoyed meeting with you. I really appreciate your time.
My pleasure, Jamie. Thank you.
Thank you.